Hi, I'm Ray, CRE Broker, and today we're breaking down the latest Federal Reserve minutes. What they reveal, what they don't, and what this all means for commercial real estate investors. The big takeaway? Uncertainty. The Fed made it clear that they're in no rush to cut rates despite months of speculation. Inflation has cooled, but not enough. The job market remains strong, but not weak enough to trigger a policy shift. So for now, the Fed is taking a wait-and-see approach, and that means interest rates are staying higher for longer. After 3 consecutive rate cuts last year, many were hoping for more relief in 2025. Instead, the Fed is signaling that they won't move until they see either real progress on inflation or a significant slowdown in employment. And so far, neither has materialized in a meaningful way. The recent jobs report showed steady gains, with unemployment ticking down to 4%, while January's inflation data came in a little hotter than expected. The Fed's preferred inflation gauge comes out next week, the PCE index, and if that number shows further cooling, it might set the stage for a shift later in the year. But for now, the message is clear. They're not in a hurry to change course. So where does that leave us? Interest rates remain elevated, and borrowing costs aren't coming down anytime soon. The 10-year Treasury yield is sitting at 4.53%, and that's a critical benchmark for commercial real estate financing. With debt still expensive, underwriting has become more challenging, and valuations are feeling the pressure. The cost of capital is forcing investors to either adjust their expectations or get creative with financing. And if that weren't enough, the Fed flagged another potential risk to inflation: trade policy. Firms are already warning that new tariffs could push costs higher, and if inflation ticks back up, it could delay rate cuts even further. The next big moment to watch is the Fed's March meeting. Powell's language will set the tone for the second quarter, and investors should pay close attention to whether the Fed starts shifting toward an easing cycle or sticks with its cautious stance. Until then, it's all about staying informed and adapting to the market we have, not the one we hope for.